when we look at the economic landscape of 2025, we are witnessing one of the most consequential policy experiments in modern American history. The return of President Trump to the White House has fundamentally reshaped our economic trajectory, and the data tells us a story that is far more complex and nuanced than simple political narratives would suggest. Let me start with the headline numbers, because they reveal something quite striking about where we stand today. Real gross domestic product in the second quarter of 2025 increased at an annual rate of 3.8%. This came after a negative 0.6% contraction in the first quarter. Now, on the surface, this looks like a dramatic recovery, but when you dig into the details, what you discover is that this growth was primarily driven by a massive decrease in imports, which by the nature of GDP accounting actually adds to growth figures. Meanwhile, consumer spending increased, but investment and exports both decreased. What happened here is fascinating from an economic perspective. In the first quarter, businesses engaged in what we call front-loading. They rushed to import goods ahead of expected tariffs, which explains why imports surged and GDP contracted. Then in the second quarter, imports plunged by 29.3%, the largest decline outside of a recession since 1969. This wasn't organic economic growth. This was a reaction to policy uncertainty. The volatility in trade flows created by the tariff regime has made it extremely difficult to assess the underlying health of the economy. The Federal Reserve Bank of Atlanta's GDP Now model, which provides real-time forecasts, currently estimates third quarter growth at 4.2%. But private sector forecasters are more cautious. According to the Wall Street Journal quarterly survey from October, the median forecast for third quarter GDP growth was 2.7%. And looking ahead, growth is projected to decelerate significantly. Ernst and Young forecast real GDP growth of 1.7% for 2025 overall and 1.4% for 2026. This represents a substantial slowdown from the economic momentum we saw in prior years. Now, let's talk about what's really happening in the lives of ordinary Americans, because this is where the economic story becomes most troubling. Consumer sentiment has collapsed to near historic lows. The University of Michigan's Index of Consumer Sentiment registered 51.0 in November, down from 53.6 in October. This is the second lowest reading in the history of the index, which dates back to 1978. The only time sentiment was lower was in June 2022, when inflation was hitting 9% annually. What's particularly striking about this collapse in sentiment is its breadth. It's widespread across age groups, income brackets, and political affiliations. The ongoing federal government shutdown, which has dragged on for over a month as of early November, has consumers expressing serious worries about potential negative consequences for the economy. The current economic conditions index dropped to 51.1, its lowest level in the index's entire history. The index of consumer expectations hit 49, an all-time historic low. But here's where it gets really interesting from a distributional perspective. There's one group that's actually feeling more optimistic. Consumers with the largest holdings of stocks, the top 20%, posted a notable 11% increase in sentiment in early November, supported by continued strength in stock markets. This reveals something fundamental about the economy we're living in today. It's what economists call a K-shaped recovery, but it's really more than that. It's a bifurcated economy where asset holders are doing extraordinarily well, while everyone else is struggling with high prices and stagnant real wages. The wealth effect has become dramatically more potent in recent years. Today, a $1 increase in stock wealth leads to a $0.05 marginal propensity to consume, up from less than $0.02 in 2010, according to Oxford Economics. This means that rising stock prices are supporting consumption, but only for those who own stocks. Meanwhile, for the roughly half of Americans who don't have significant stock holdings, the economic picture looks very different. Now let's address the elephant in the room, tariffs. The Trump administration has imposed the most comprehensive tariff regime since the early 20th century. The average tax on United States imports today is nearly 18%, according to economists at the Budget Lab at Yale, up from 2.4% before Trump returned to the White House. The Treasury Department is collecting almost 4 times as much tariff revenue now as it was a year ago. The administration has imposed tariffs through various legal mechanisms, including International Emergency Economic Powers Act tariffs on China, Canada, Mexico, and the European Union, and Section 232 tariffs on autos, heavy trucks, steel, aluminum, lumber, furniture, semiconductors, pharmaceuticals, and copper, among others. According to the Tax Foundation, these tariffs amount to an average tax increase of $1,200 per United States household in 2025 and $1,600 in 2026. The weighted average applied tariff has increased to approximately 23% according to J.P. Morgan calculations. This represents the largest tax increase as a percentage of GDP at 0.52% for 2025 since 1993. By any measure, this is a massive fiscal policy intervention. Now, the critical question is, what are these tariffs doing to inflation and economic growth? This is where the evidence becomes quite complex and frankly contradictory in some respects. Let me walk you through what we know. The Consumer Price Index in September 2025 showed 12-month inflation of 3%, the same figure recorded in January before Trump had imposed any major tariffs. On the surface, this suggests tariffs haven't caused inflation to accelerate. Some categories that are heavily dependent on imports, like apparel, which is 97% imported from countries facing high tariffs, actually showed no price increase over the 12-month period. New vehicle prices have remained essentially flat. However, this doesn't mean tariffs haven't affected prices at all. Research from Harvard University economist Alberto Cavallo and colleagues found in an October paper that the inflation rate would have been drastically lower at 2.2% had it not been for Trump's tariffs. Bank of America estimates that tariffs are adding about 0.5 percentage point to the core personal consumption expenditures price index that the Federal Reserve uses when assessing inflation. So why aren't we seeing more dramatic price increases? There are several factors at work. First, companies built up inventories ahead of the tariffs, so they've been drawing down existing stocks purchased at lower prices. Second, businesses are absorbing some of the costs through compressed profit margins. General Motors, for example, said tariffs cost the company about $1.1 billion in one quarter, but they largely absorbed those expenses rather than immediately passing them on to consumers. Third, the strong dollar has offset some of the tariff impact on import prices. But this can't last indefinitely. As inventories run down and companies exhaust their ability to absorb costs, we should expect to see more pass-through to consumer prices. J.P. Morgan estimates that the announced measures could boost personal consumption expenditures prices by 1 to 1.5% this year, with the inflationary effects mostly realized in the middle quarters of the year. LendingTree's Budget Lab estimates that some 70.5% of new tariffs were passed on to consumers by June 2025. There's also fascinating new research from San Francisco Federal Reserve economists that challenges conventional thinking. In a working paper, researchers Rajesh Barnachan and Ayush Singh examined 150 years of tariff data and found that tariffs actually act as aggregate demand shocks, moving inflation and unemployment in the same direction initially, but then leading to lower inflation over time as economic activity weakens. They found that before World War II, a permanent 4 percentage point increase in the tariff rate reduced inflation by 2 percentage points, but raised unemployment by about 1 percentage point. The mechanism appears to be that tariffs create uncertainty that hits consumers and investors' confidence, depressing economic activity. They also found evidence that tariffs triggered drops in asset prices and increases in stock market volatility, which weigh on demand. This suggests we may be at the beginning of a process where tariffs initially boost prices but then lead to weaker growth and eventually lower inflation, though at the cost of higher unemployment. Global growth has already taken a significant hit JP Morgan estimates that global real GDP growth is expected to be 1.4% in the fourth quarter of 2025, down from 2.1% at the start of the year. The tariffs significantly reduce United States and global economic growth and increase inflation in many economies, depending on how countries respond. Research from the Peterson Institute for International Economics finds that the outcomes are less severe than the original April 2nd announcements implied, due to many exemptions and adjustments, but retaliation by other countries worsens the economic losses. Let's talk about labor markets, because this is where we're seeing some concerning trends that aren't yet showing up dramatically in the headline unemployment numbers. Total payroll job growth averaged 51,000 per month during the first 2 months of the third quarter of 2025, after averaging 55,000 per month during the second quarter. The slower growth partly reflected the shedding of federal government jobs, with a monthly average decrease of 12,500 in federal employment. But the bigger concern is what's happening beneath the surface. Forced deportation and voluntary self-deportation of illegal immigrants has reduced labor supply. The Department of Homeland Security announced that more than 527,000 illegal aliens have been removed, and more than 2 million illegal aliens have left the United States, including 1.6 million who voluntarily self-deported. However, the Heritage Foundation released a report stating that the Trump administration is significantly off pace on mass deportations compared to its stated goals. The reduction in immigration is having real effects on labor supply in sectors that have traditionally depended on immigrant labor. At the same time, labor demand has similarly decreased, which is why we haven't seen a spike in unemployment yet. But this creates a dangerous dynamic where the economy has less capacity for non-inflationary growth going forward. Consumer confidence in the labor market shows mixed signals. According to the New York Fed's survey of consumer expectations for October, the mean probability that the United States employment rate will increase a year from now increased to 42.5%. But the probability of finding a job if one's current job is lost fell to 46.8%. People are simultaneously less worried about losing their jobs, with the probability dropping to 14%, but more pessimistic about their ability to find new employment if they need it. This suggests we're moving toward a labor market where job security for those currently employed remains relatively stable, but mobility and opportunity for those seeking new positions is deteriorating. This is exactly the kind of environment that can keep unemployment low in the short term, but create significant fragility if any negative shock hits the economy. Now let's discuss the government shutdown, because it's adding a whole additional layer of economic uncertainty. As of October 31st, the federal government had been shut down for over 4 weeks, and it continued for at least a 5th week. The shutdown reduces current quarter GDP growth through several channels: direct lost output from furloughed workers, secondary consumption effects as federal workers await delayed paychecks, and ancillary impacts on complementary industries like government contractors and local services. More importantly, the shutdown has delayed surveys and reports that are used to estimate GDP. Official data on real GDP growth for the third quarter wasn't available until normal government operations resumed. This means policymakers and economic actors have been making decisions with incomplete information, which adds to the general climate of uncertainty that's already elevated due to tariff policy. The median economist in the Wall Street Journal survey projected a 33% chance of a recession in the next 12 months, little change from the 35% chance estimated in July. But I would argue this understates the risks we face. The combination of tight monetary policy, with the Federal Reserve still maintaining interest rates at restrictive levels, aggressive tariff policy creating supply-side disruptions, and reduced immigration constraining potential growth, creates a challenging environment for sustained expansion. Let me talk about inflation expectations, because they matter enormously for monetary policy and economic behavior. Year-ahead inflation expectations from the Michigan survey inched down from 4.6% to 4.5% in November. Long-run inflation expectations softened from 3.9% to 3.4%. These are moving in the right direction, but they're still elevated compared to the 3.2% January 2025 reading for long-run expectations. The fact that inflation expectations remain elevated despite the Fed's efforts to bring them down suggests that the tariff policy is working at cross purposes with monetary policy. The Federal Reserve is trying to bring inflation back to its 2% target through restrictive interest rates, but tariffs are pushing in the opposite direction, creating cost-push inflation pressures. This puts the Fed in an extremely difficult position. If inflation remains stuck above target due to tariffs, the Fed may feel compelled to keep rates higher for longer, which risks tipping the economy into recession. But if growth weakens significantly, the Fed will face pressure to cut rates even with inflation above target, which could lead to an unanchoring of inflation expectations. Looking at the stock market, we see another dimension of the bifurcated economy. Stock markets have hit record highs multiple times during this period, with both the S&P 500 and NASDAQ recently setting new records. This reflects several factors. Strong corporate earnings, particularly in technology sectors driven by artificial intelligence, investment, the fact that large corporations have been able to pass through cost increases to consumers, and expectations that the administration's pro-business policies will support profits. But stock market strength is not the same thing as broad-based economic prosperity. In fact, it may be masking underlying weaknesses in the real economy. The divergence between soaring stock prices and collapsing consumer sentiment is historically unusual and suggests a fundamental disconnect between financial markets and the lived experience of most Americans. From a fiscal perspective, tariff revenues have increased substantially, but they're not solving our budget problems. In September, tariffs accounted for just 6% of total government revenue. The jump in tariff revenue that month was more than offset by a decline in corporate tax payments. So the net effect on the fiscal position has been minimal. Meanwhile, the political economy of tariffs is becoming increasingly problematic. Voter anger about worsening affordability delivered stunning losses to Republicans during off-year elections in November. In response, President Trump announced he's scrapping tariffs on beef, coffee, and a range of other commodities. This reactive approach to tariff policy based on short-term political considerations creates even more uncertainty for businesses trying to make long-term investment decisions. The Supreme Court is currently reviewing the legality of Trump's tariff policies, particularly those imposed under the International Emergency Economic Powers Act. Based on the justices' questioning during oral arguments in early November, there appears to be skepticism that a president has the authority to impose such sweeping tariffs without new legislation from Congress. If the court strikes down these tariffs, it would create yet another massive shift in trade policy, potentially leading to another surge in imports and further volatility in economic data. Let's talk about what this means for different sectors and regions. Agriculture has seen wild swings, increasing in 27 states and being the leading contributor to growth in 6 states, including Kansas, which had the third largest increase in real GDP. But agriculture was also the leading offset to growth in 6 states, including Arkansas and Mississippi, the 2 states where real GDP actually declined. This reflects the complex effects of both tariff policy and retaliatory tariffs imposed by other countries on United States agricultural exports. Manufacturing, which was supposedly the primary beneficiary of tariff protection, has shown mixed results at best. Even with tariffs in place, companies report that the cost to import in many cases is still more attractive than sourcing within the United States. The tariffs haven't triggered the reshoring boom that was anticipated. Instead, they've created supply chain disruptions and uncertainty that's discouraging investment. The wild swings in tariff rates from 30% to over 100% on some goods have created particular challenges for importers who typically order products months ahead of time. An anonymous computer manufacturer quoted in an Institute for Supply Management report said the unpredictability of the tariff situation continues to cause havoc and uncertainty. Personal income increased in all 50 states and the District of Columbia in the second quarter, with the percent change at an annual rate in current dollar personal income at 5.5% nationally. But this national figure masks significant variation with state-level changes ranging from a 10.4% increase in Kansas to a 0.9% increase in Arkansas. The personal saving rate was revised higher to 5.3% in the second quarter from an earlier estimate of 4.6%. This suggests healthier household finances heading into the second half of 2025 than previously thought. However, consumers continue to report that their personal finances are weighed down by the present state of high prices, even as inflation expectations for the future have improved. What about the international dimension? Let me touch on some key relationships. With China, by April 2nd, the United States had raised tariffs on Chinese goods to an effective rate of 145%, and China had countered with a 125% tariff on United States imports. This represents a complete breakdown in the trade relationship between the world's two largest economies. Beijing is grappling with how the U.S. peace drive in Ukraine will impact Chinese leader Xi Jinping's carefully wrought partnership with Russian President Vladimir Putin. On Ukraine, the Trump administration approved the first package of arms sales under the NATO-led Prioritize Ukraine Requirements List initiative in September, authorizing up to two $500 million shipments. However, a plurality of Americans, 43%, see Trump favoring Russia too much in his handling of relations with Russia and Ukraine. In the Middle East, President Trump announced a 20-point Gaza peace plan in September alongside Prime Minister Netanyahu, and in October announced that a ceasefire between Israel and Hamas had been reached. The United States strikes on Iran's Fordow facility in June marked a significant escalation, and the first large-scale United States strikes on Iranian targets in nearly 40 years. Let me also mention that border encounters on the southern border dropped dramatically, from 189,359 encounters in March 2024 to 11,017 encounters in March 2025, the lowest monthly total in the past 3 years. This represents a major policy success from the administration's perspective, though questions remain about the economic impacts of reduced immigration. Now, let me synthesize what all this means for the future trajectory of the economy. We are in a period of heightened uncertainty with multiple cross currents. On one hand, we have strong consumer spending from high-income households, continued artificial intelligence-driven investment, and a resilient labor market that hasn't yet shown major stress. On the other hand, we have collapsing consumer sentiment, elevated inflation that's stuck above the Fed's target, tariff policies creating ongoing disruption, and slowing growth momentum. The combined drag from tariff-related cost increases, persistent policy uncertainty, reduced immigration, and elevated interest rates will weigh on business investment, household consumption, and housing activity going forward. The bifurcation between asset holders who are optimistic and workers without significant stock holdings who are pessimistic suggests a fragile foundation for sustained growth. My assessment is that we are likely to see continued deceleration in growth through 2026. The economy will avoid outright recession if tariff policy stabilizes and the Federal Reserve begins cutting interest rates, but growth will be below trend. Inflation will remain elevated above the Fed's 2% target, potentially settling in the 2.5 to 3% range, which creates a stagflationary dynamic of slow growth and persistent inflation. The labor market will gradually weaken, with unemployment rising modestly but job-finding rates deteriorating more significantly. This will create political pressure for policy changes, potentially leading to some rollback of tariffs or other measures to support growth. The biggest risk is that some exogenous shock, whether from geopolitical events, a financial market correction, or an unexpected policy decision, tips the economy into recession. In that scenario, the combination of high inflation and rising unemployment would present extremely difficult choices for policymakers. The return to the White House has certainly been transformative for economic policy. Whether this transformation proves beneficial in the long run depends critically on whether the tariff strategy succeeds in reshoring manufacturing and creating high-wage jobs, or whether it simply raises costs for consumers and businesses while triggering a broader slowdown. The evidence so far suggests more of the latter than the former, but the full effects will take years to become clear. What we can say with confidence is that we are living through one of the most significant policy experiments in modern American economic history, and the outcomes will shape not just our domestic economy, but the entire global economic order for decades to come.